shall we dive into what will be driving this local market? James Garish from Shaw Partners and Market Matters joins me now. James, welcome. Just talk to us about what you're expecting from this Wednesday session today.
Yeah, it's going to be a bullish one, Nadine. SPI futures are up 25, but we've now the market's sort of up 50. So a more bullish one than perhaps the futures market was implying. And also that comes on the back of yesterday's 1.2% advance for the ASX, which sort of came on the back of perhaps some risk off going into the Easter long weekend, etc. So a positive one with commodities to lead the charge today, Nadine.
Yeah, commodities are going really well early on. You heard me detailing that news from Whitehaven Coal. I doubt you've had a lot of time to delve right into it, but it looks as if they're expecting production to come in below guidance. Still though, price strong. They're still selling lots of coal and shipping it out. Is this anything to be concerned about as a shareholder?
Yeah, it's not a good update from Whitehaven this morning. So lower production puts the unit costs higher, which is not a great read through. You've also got, while coal prices are higher, they're coming off while coal prices are strong, they're coming off some pretty high levels. So they've got a lower coal price environment than they had 6 months ago. They've got lower production and higher unit costs. So this stock is going to get hit today. We're owners of Whitehaven Coal. We've been we've had it for a while now, but it's going to be a weak session, about to open at 667 on my screen at the moment. 665 now, down quite a few percent.
Okay, James, with that in mind, obviously that's something to hang our hats on early on. Where are you also looking for opportunity in the commodity space?
So just a couple of things caught my eye yesterday. I mean, Sandfire was really strong. It was up nearly 7% yesterday. That's obviously copper play here in Australia. It's you cast your mind back with BHP taking Oz Minerals off the board. Sandfire becomes the premier copper stock on the ASX by default. So it's benefited from an improvement operationally, but also the flow of money coming out of Oz Minerals and looking for a pure play home on the ASX, and it's certainly gone into Sandfire. We own it from sub $4. It's now knocking at door on $7, so it's obviously up a long way. So we're sort of contemplating our position when if we move towards this rhetoric from an economic standpoint, that we've got tougher conditions ahead, then copper prices, while we're positive on the medium to longer term in terms of copper, if this focus comes on economic weakness into the back end of the year, copper prices will probably struggle, and perhaps it's not a bad time to be locking in some profits out of a Sandfire position, Nadine.
Okay, interesting, because that's the key, isn't it, to know when to crystallize some of those gains. AGL is on your list to speak of today. Why is that?
Yeah, we've spoken about the last couple of weeks. We bought it sub $7. It's now above $8.50 in about 6 weeks. So it's been a really strong performer in our income portfolio. I guess it's now trading above the bid price that Cannon Brooks and Co. Made a tilt for AGL back 6 or 7 months ago. So to me, the market was very negative on this stock. The rhetoric's starting to change around the decarbonisation thematic. AGL is going to be forefront in this move to decarbonisation. So to me, though, now it's sort of approaching that fully valued range. We had a $9 target in mind for it. It's nearly, we're 40 or 45 cents below that target now. So, the lion's share of the gains in that position, I think, is done. We still own it. We haven't sold it. But if it gets nearer $9, we're going to be sellers of that. Similar to one move we made yesterday in our income portfolio was selling Transurban, infrastructure stock, great toll road operator, but really fully valued, Nadine. So I think to your point, you've got to be more nimble in this market. I think it's a market where being active around positioning is going to yield better returns over the rest of the year.
Okay. NextDC is another company that's been out with an update. So what do you make of NextDC, if now is a time to be active in the portfolio? I mean, do you like it as an infrastructure type play? Do you look for leverage because it's tech?
Yeah, I mean, they did come out with a great update this morning. So stocks trading up nearly 9% at time of record, at the moment. So, it's been a stock we've had in the emerging companies portfolio. It's done well for us over the past 6 months. They came out and said utilization is going to be higher, and that was one of the market's concerns with NextDC, that utilization was from some of their major customers was trending lower, particularly that was happening in the second half of last year. But this year, it's really turned around. So that utilization number's great, and that's driving a sort of re-rate in the stock. It's now $12, which is sort of around the target we had in mind for it. So it's fairly expensive, but it's a quality stock, and they're starting to deliver once again after a period of relative weakness in terms of both performance and the share price, Nadine.
Okay, NextDC, we'll be watching that throughout the day as well. So AGL, NextDC. So are these markets giving you a lot of, opportunity to, to review the portfolio? I know that it's always a work in progress. That's what you're always doing, James. But do you feel like there's just more opportunities to make some moves now?
Yeah, every day is sort of a new day, and you come in here with a fresh set of eyes. But I think a couple of the trends that we're sort of thinking about right now, and we're making a couple of moves on our growth portfolio today aligned with these. I think there's been a huge outperformance across technology stocks over the past couple of months. So technology versus the more economically sensitive industrial parts of the market. There's been a huge variance in performance there. That's you think about where bond yields have been declining, which has been supportive of tech stocks. But you think about bond yields now; they're pricing in a fair number of interest rate cuts, particularly in the US this side of Christmas. So we actually think that's overblown. So I wouldn't be surprised to see bond yields higher in the next month or two, and that's going to put some pressure on technology. So we're just tweaking our overweight technology position down a touch. And going into a more defensive positioning v tech for the next couple of months. So I think around it's not making huge bets either way, but tweaking portfolios to be overweight and underweight particular sectors given the headwinds or prevailing tailwinds that are playing out within that sector. So that's in our view what active management's about, and that's what sort of delivers consistent outperformance across portfolios, Nadine.